Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Caterpillar Inc., ticker symbol CAT, the massive industrial titan that builds the foundational infrastructure of the modern world.
And we are hitting the central investment conflict right away because it is, frankly, a colossal dilemma that's defining the stock right now.
Right.
Caterpillar is betting its massive $39.8 billion record backlog and its radical plan to double CapEx into high-growth AI infrastructure will secure long-term market dominance.
And that aggressive strategic move is designed to justify its current margin compression and operating friction, which is caused by this stunning $1.6 billion tariff headwind and a very deliberate pivot toward building capacity over just near-term efficiency.
That is truly the tension in a nutshell.
It really is. It's like the industrial equivalent of juggling chainsaws while at the same time trying to launch a satellite into this massive, booming new orbit.
Yeah. On one side, you've got these incredible secular tailwinds, the AI demand, data centers, electrification. It's all demanding immediate, massive scale.
Right. And then on the other side, you've got these immediate, very tangible geopolitical costs and all the internal friction of, radically restructuring a multi-billion-dollar business for the long haul.
And the core decision they've made, it seems, is that the opportunity is just so enormous, they are willing to simply absorb the costs of that friction today to go out and seize the future.
It's a huge bet.
Exactly. And what's fascinating here is that management is being completely transparent about this trade-off. They aren't trying to hide the friction. They are basically asking investors to look past it, betting that the long-term capacity gains will dwarf these near-term costs.
So to understand that, we have to start with their 2025 Investor Day back in November, right? That's where they laid all this out.
That's the foundation. It's where they laid out the groundwork for this massive, aggressive long-term bet.
Okay, so let's unpack that strategic pivot. You mentioned they are moving away from that sort of short-term margin optimization that, analysts love to reward in quarterly reports. What does that actually mean for capital allocation?
It means they are prioritizing the physical ability to manufacture and deliver products over, let's say, maximizing the profit percentage on this quarter's sales. The scale of the commitment is truly monumental. When you compare the current strategic period, so 2025 through 2030, against the 5 years before that, 2019 to 2024, management committed to doubling. That's a 2 times increase their machinery, power and energy, or MP&E capital expenditure.
Doubling CapEx. That is an aggressive move for any mature industrial company. This isn't just, routine maintenance. This is adding massive new production lines, new facilities.
Entirely new machinery. It suggests a really high level of confidence in sustained accelerating demand that their existing assets just can't handle.
Precisely. And that level of investment isn't cheap. It puts immediate pressure on free cash flow and near-term profitability metrics, which I guess is why it requires a bit of a philosophical shift.
And that brings us to the core financial metric they're championing. They're focusing on growing absolute OPEX dollars, that's operating profit after capital charge, not just optimizing percentage margins.
Okay, now OPAS is a pretty technical term that a lot of our listeners might not be familiar with, so we should probably deep dive into this. Why is OPACI the guiding star for Caterpillar right now, and why does it matter more than a simple profit margin?
Well, it's the metric that truly defines economic value creation for a business this capital intensive. Operating profit after capital charge. It basically calculates your operating income, and then it subtracts the dollar cost of the capital, both debt and equity, that you use to generate that income.
So if your OPAS is positive, you're creating value.
You're generating returns above your cost of capital. You're creating economic value. If it's negative, you are, in effect, destroying value, even if you are reporting a positive net income.
So it forces management to constantly prove that every single dollar they invest, whether it's borrowed money or shareholder equity, is actually earning more than it costs.
Exactly. And for a company that is about to double its CapEx, this is just critical. The CEO and CFO were really clear. They acknowledge upfront that pursuing major volume opportunities, like those massive data center deals we're going to talk about, may not always be margin accretive in the short term.
So the initial cost might hurt the percentage?
Right. The costs to scale up production, hire staff, or even offer a slight price concession to lock in a massive deal that might temporarily compress the margin percentage. But if that deal uses the new capital efficiently and drives high absolute OC dollars over its life, then it's a key driver of total shareholder return in the long run.
It shifts the focus from, I guess, efficiency to value creation through disciplined growth.
That's the perfect way to put it.
And this philosophical shift then dictates the financial targets they've set for 2030.
Yeah.
So let's talk about those long-term goals. What kind of growth are they modeling between now and 2030?
They're modeling very robust growth, but it comes with a big caveat, assuming stable global economic conditions.
Of course.
Under that assumption, they're targeting an enterprise sales compound annual growth rate, or CAGR, of between 5 and 7% through 2030. Now, for a company of Caterpillar's immense size, a sustained 5% to 7% growth rate is genuinely strong. It indicates some serious market share capture or market expansion.
And as we always emphasize here, for an industrial company, that's stability and resilience. It doesn't just come from the initial sale, right? It's about the highly profitable aftermarket streams.
That's the strategic gold mine. The services revenue segment is arguably the most valuable long-term asset they are building. They're aiming to grow services revenues from $24 billion in 2024 to a staggering $30 billion by 2030.
And that's not just a guess. It's a calculated outcome of this strategy.
It's a calculated outcome of their CapEx strategy. That $6 billion increase depends heavily on two things. Sophisticated digital initiatives, predictive maintenance, but far more crucially, placing new high-value equipment into the field today, which then generates parts and service revenue for decades to come.
So the more they build and sell now, the larger and more resilient that $30 billion services moat becomes later on.
Precisely.
And while they're undertaking this massive internal restructuring and capital ramp, their commitment to shareholders has to stay paramount to keep investors on board. They can't just hoard all that cash for CapEx.
Absolutely not. And they've maintained a very clear commitment. Caterpillar committed to continuing to return substantially all of their machinery, power and energy, or ME&T, free cash flow to shareholders. Just look at the track record. In the 2019 to 2024 period, they returned a stunning 99% of that ME&T free cash flow.
99%.
This signals that the CapEx they need for growth is being managed within their operational cash flow, not at the expense of returning capital. And they are also committed to consistent high single-digit dividend increases, which is key for a lot of investors.
Right. Now, a company scaling towards potentially $100 billion in sales has to adjust its financial benchmarks. They adjusted their adjusted operating profit margin, or AOPM, targets. What does that tell us about their confidence?
The range extension is a very strong signal of confidence. They're moving the margin targets to cover annual sales and revenues up to $100 billion. The crucial detail here, though, is that they expect to maintain a similar profit pull-through rate in this new higher range as they did in the previous lower range, which was between $42 and $72 billion.
Okay, that profit pull-through rate is critical. That refers to the percentage of every new dollar of revenue that actually turns into profit, right?
That's it. So if they can maintain that rate while scaling from, say, $72 billion to $100 billion, it suggests massive operating leverage is kicking in, fueled by these new efficient capital assets.
It suggests their discipline is intact, even at that kind of unprecedented scale.
It does. I mean, when a company scales volume that fast, sometimes fixed costs get absorbed efficiently, but other times variable costs, especially in supply chains, can escalate and hurt margins. By saying they can maintain that pull-through rate up to $100 billion, they're basically telling the market, our long-term cost structure is competitive, and these new investments are designed to be highly profitable.
So it's their way of assuring investors that focusing on OPAC doesn't mean they're abandoning margin discipline completely.
It just means margin takes a backseat when it conflicts with strategic, disciplined volume growth.
Okay, that gives us the long-term financial roadmap. Now, let's unpack where this belief in getting to near $100 billion in sales and $30 billion in services is coming from, because as you said, it hinges almost entirely on one single massive secular trend.
The AI and data center boom.
Exactly. This leads us right to the power and energy segment, P&E.
The power and energy segment is explicitly and deliberately positioned as the company's largest growth engine going forward. I mean, the sheer magnitude of the demand they are projecting is just staggering.
What's the strategy?
The strategy is audacious. They believe the P&E segment is positioned to more than double its power generation sales by 2030. This is not incremental growth. This is a fundamental reweighting of their entire business toward industrial power.
And the reason for doubling P&E sales rests on these truly incredible forecasts for global power consumption, which is driven almost entirely by AI.
It's entirely tied to the exponential growth of data centers. I mean,
Yeah.
just look at the independent data. The IEA, the International Energy Agency, suggests that power demand from data centers globally is expected to triple in the next 10 years.
Triple.
We're moving from just utility-scale power needs to needing entirely new, dedicated microgrids just to power a few of these massive hyperscale facilities. This creates an immediate, acute bottleneck that utilities, they just can't fill it fast enough.
And that's where Caterpillar steps in. Not just for the traditional emergency backup power, but increasingly for primary continuous power generation. That shift is absolutely key, isn't it?
It is the absolute key to this whole investment thesis. Historically, CAT gensets were mostly used for standby power. They might run a few dozen hours a year, get tested occasionally. Reliable, but a mature market.
Right.
Now, with utilities struggling to deliver power fast enough, you've got permitting delays, grid congestion, renewables, volatility. Data center customers are turning to CT for primary power solutions.
So if a utility tells a hyperscaler it's going to take 5 years to upgrade the lines for 500 megawatts of power, CT can step in and provide that power almost immediately with on-site engines running 24/7.
That speed to power is the ultimate competitive advantage right now. It is the crucial competitive differential. In the data center world, time is power, and power is money. Every day a massive data center sits idle waiting on a utility is just a huge loss. CT solutions offer rapid deployment months instead of years, creating these sophisticated, reliable microgrids.
It's a much stickier business than just selling a backup generator.
Higher margins, stickier, everything. And this soaring demand is what necessitates that monumental capacity build-out we talked about earlier. You can't double P&E sales without having the engines ready to ship.
So what are the numbers there?
The capacity numbers are just breathtaking. They are doubling capacity for their large engines. These are the big reciprocating engines, often running on natural gas that serve power generation and oil and gas. They're workhorses.
And then there's the even more dramatic increase in their solar turbines capacity.
Yes, the solar turbines capacity is being increased by 2.5 times a 2.5x increase. This investment is tailored directly for that soaring demand in gas compression and power generation, especially for data centers. Turbines are built for extremely high run hours, which makes them ideal for prime power applications.
So what does that mean for their supply chain? I mean, increasing capacity 2.5 times for something as complex as a turbine must require a ton of planning and tooling.
It requires deep capital commitment right now, assuming that demand curve stays steep and continuous. This expansion is already underway, but it's a multi-year project. They are building highly specialized manufacturing lines. And this investment, well, it gives them a massive first-mover advantage.
What's the total target?
They're aiming for 50 gigawatts of combined engine and turbine power generation capacity by 2030. If AI power demand really does triple, the market needs players who can deliver that scale fast, and CCAT is positioning itself as the primary provider.
And their strategy isn't just selling the hardware, the engine block. It's about providing the full integrated solution.
Correct. The goal is to simplify the whole process for the customer. Data center developers don't want to piece things together. They want a single, cohesive power solution that speeds up commissioning. By providing the full powertrain, controls, everything, CAT reduces that complexity and locks in a long-term relationship.
And crucially, a very lucrative service contract. Yeah. And they've cited some tangible examples already that prove this is working. Let's use those as sort of mini case studies here.
Yeah, they pointed to a major project with Jewel Capital Partners for Utah's largest data center. This wasn't just a standby job. It utilized natural gas engine gensets for both primary and backup power.
The integrated solution in action.
Exactly. But the critical takeaway isn't just the sale, it's that the project is secured by a 10-year service agreement. That's a decade of guaranteed aftermarket revenue from one installation.
And what about the scale? The Williams project was another one.
A massive win, with Williams, the natural gas infrastructure company, for over 1 gigawatt of power. That's huge utility-scale capacity. It used a mix of engine and turbine-based generator sets, showing CKey can tailor the technology, and again, backed by a strong services agreement. These wins just validate that the market is already shifting.
Which brings us to the core value driver, that long-term annuity stream. The initial sale is a one-time thing, but the next decade or two of servicing that equipment, that's where the lifetime value is, especially for these prime power units.
This is the ultimate payoff of this entire massive bet, and you really have to understand the numbers here. Management quantified the difference with a spectacular metric. A single natural gas prime power engine set offers over 40 times more services opportunity over its life cycle compared to a standard diesel standby unit.
40 times. That's an enormous multiplier. We need to break down the mechanics of why that ratio is so high.
It all comes down to run hours and utilization. A standard diesel standby unit might run, 200 hours a year? It needs minimal maintenance, infrequent parts. A natural gas prime power unit feeding a data center might run 8,000 hours a year, 247. The utilization is 40 times higher.
So the moment that engine hits 8,000 hours, you trigger a maintenance cycle. At 16,000, another one. And then eventually you hit a major overhaul.
Yeah, precisely. The continuous operation just accelerates the need for everything. Filters, oil, spark plugs, cylinder head overhauls, and eventually a full engine rebuild. Each one of those steps is a scheduled high-margin revenue event that's baked into that long-term service agreement. It's a guaranteed annuity.
The sheer volume of parts and labor drives that 40x multiplier.
It's why they're not just selling a machine. They are selling a guaranteed multi-decade servicing relationship that feeds that $30 billion services goal.
They're seeding the field.
They're seeding the field. But investors absolutely must be patient here. While the capacity build-out is happening now and sales are growing, the majority of that 40x services revenue, the really high-margin stuff, is expected to kick in materially well beyond 2030 or even 2035.
Right. That's when this first wave of engines deployed today starts hitting those major overhaul milestones.
It's a multi-decade play. It requires conviction, not quarterly impatience.
Okay, now that we've established this ambitious long-term vision, let's ground ourselves back in the immediate present. Let's look at the Q3 2025 earnings call and their recent financials. The results show strong momentum, but also that immediate painful friction we talked about at the start.
The momentum is undeniable. Caterpillar reported record consolidated sales and revenues of $17.64 billion in Q3. That was up 10% year over year. Strong execution, strong pricing power.
And the high demand, particularly in energy and transportation, is flowing right through to a massive order book. That gives them incredible visibility into next year.
Absolutely. The company achieved an all-time high backlog of $39.8 billion. That backlog grew sequentially by about $2.4 billion, and the main driver was E&T, specifically those power generation orders.
So that backlog gives them a buffer.
A huge buffer. Management noted it currently covers over 80% of their implied second-half sales, which is an exceptional buffer against any unexpected cyclical dips. And adjusted EPS for the quarter was strong at $4.95.
However, despite the record sales, the huge backlog, strong EPS, we see the immediate financial impact of those headwinds when we look at the profitability.
That tension is glaringly visible in the operating profit figures. Consolidated operating profit actually decreased by 3% year over year, and adjusted OP was down 4%.
And as a result, the adjusted operating profit margin, the AOPM, compressed to 17.5%.
Right. And a 17.5% margin puts them near the bottom of their long-term target range, especially when you factor in the tariff impact. This clearly illustrates the cost of that friction.
So the tariffs were the main culprit.
Management confirmed it. They said the margin compression was directly attributable to the net impact of incremental tariffs being near the top end of their estimated $500 to $600 million range for just that quarter. The tariffs are an unavoidable cost hitting all three segments, acting like a giant anchor dragging down their profitability.
But despite that profitability drag, the underlying financial health, the liquidity of the company, that remains stellar, which is crucial for funding this CapEx.
That is the essential counterpoint to the margin stress. They are generating cash at an industrial pace. SEAT generated $3.2 billion of ME&T free cash flow in Q3 alone.
Wow.
For the full year, they expect FCF to be above the midpoint of their generous $5 billion to $10 billion target range. That massive FCF generation ensures they can fund the CapEx doubling and maintain their commitment to returning cash to shareholders.
And the health of their customer base, the people buying the machines, that's also a major factor for stability.
It is a phenomenal signal of economic health. Customer financial health is exceptionally strong. Past dues were only 1.47%, which is the lowest third-quarter level in over 25 years.
So customers are healthy, credit quality is high.
And the risk of write-offs is minimal. This strong balance sheet and robust customer health are precisely what give management the confidence to pursue this high-cost, capacity-heavy strategy.
Okay, now we have to get to the primary reason for that margin friction, which we've mentioned a few times. The geopolitical risks, specifically the tariffs. We really need to detail the size and scope of this cost because it is genuinely jaw-dropping.
Jaw-dropping is the right word. Management themselves called this a massive tax on the business, and that's how we need to think about it. The net incremental tariff impact for the full year 2025 is expected to be between $1.6 billion and $1.75 billion.
$1.75 billion.
And this isn't a one-time charge. This is billions hitting the income statement annually, acting as a direct cost, fundamentally impacting their pricing and their ability to compete.
I mean, if they were somehow able to mitigate that cost immediately, their AOPM would look dramatically different. The whole story would change.
Completely. And they know exactly when the pain is peaking. Management guided that the fourth quarter of 2025 is expected to be the absolute peak of these tariff headwinds, with an unmitigated run rate estimated between $650 and $800 million for that single quarter.
Just for Q4.
Wow.
And they broke down where that cost is hitting the business.
That segmentation is critical. They anticipate about 55% of the tariff impact will be in construction industries, CI during Q4, 20% in resource industries, RI, and 25% in E&T.
So the heaviest burden is on CI, the iconic large yellow equipment.
Which tells you that goods flowing to or from major export-import markets are getting hammered in that segment.
So the fundamental question we have to ask is, if this cost is $1.6 billion a year, why aren't they just moving their entire supply chain out of the affected zones? Why are they just eating the cost?
This is the critical element of the strategic paralysis caused by all the trade policy uncertainty. Caterpillar is actively deferring major irreversible supply chain investments. We are talking about massive capital outlays, new factories, new tooling, shifting entire production lines, and the very lengthy, costly process of product validation.
And the reason is poorly pragmatic, even if it's painful right now. They're hedging against a policy reversal.
Exactly. I mean, the trade deals are fluid. They're subject to political change. Management doesn't want to spend, potentially billions to redesign their entire global supply chain, only to have to spend that money again to reverse it if trade policies suddenly stabilize or change course in 3 or 5 years.
So they're choosing to absorb a guaranteed massive $1.6 billion cost now, rather than risk a permanent, highly costly, and maybe unnecessary reconfiguration of their manufacturing footprint.
That's the trade-off. Is the cost of the strategic paralysis, absorbing over $1.5 billion in tariffs every single year, truly less expensive than just biting the bullet and making the move now?
It's the ultimate gamble on politics.
It is. The market doesn't have a clear answer. If the policy environment stabilizes next year, management looks brilliant. If these tariffs are still here in 5 or 10 years, then they will have unnecessarily absorbed, $8 to $16 billion in costs. Their decision reflects a belief that policy stability is a reasonable expectation in the medium term.
So it forces them to rely on these no-regrets actions like minor cost reductions and efficiencies, but those are just marginal. They can't perform the surgery needed to remove the tax.
They're managing the cost, but they're not eliminating the source of the friction. The tariff headwind remains the single largest financial drag on their near-term profitability. It is the ultimate example of geopolitical risk manifesting directly and consistently on the income statement.
Okay, let's step back and bring this all together in our final verdict. We have this monumental long-term commitment to high growth, driven by AI, which requires heavy CapEx. And that ambition is immediately weighed down by a huge, known geopolitical tax. Does the aggressive strategy justify the stock's current premium despite these headwinds?
The investment case relies entirely on the success of this aggressive long-term strategy being executed flawlessly, especially that P&E pivot. The company's foundation is demonstrably sound. I mean, they've proven their focus on growing absolute OPAC SC dollars, reporting a highly impressive 1.9x growth in OPAC since 2019.
And they have that solid commitment to returning cash to shareholders.
A reliable commitment to returning substantially all of their ME&T free cash flow. These are reliable factors that support a premium valuation.
But the whole thing hinges on the capacity bet working out perfectly and doing so quickly enough.
It absolutely does. The critical factor is confidence that the AI and data center boom will seamlessly integrate with these massive capacity expansions, the doubling of large engines, the 2.5x increase in solar turbines, and that it will drive that multi-decade 40x services growth. If P&E can truly more than double sales by 2030, the near-term tariff costs will just be a temporary footnote in their history.
But we can't ignore the very real structural risks that are still lurking there. even beyond the tariffs.
The risks are significant. First and foremost is the severity and constancy of that $1.6 to $1.75 billion tariff headwind. It's a massive immediate drag on margins, and it's forcing that strategic paralysis. That cost is certain.
And second, CLT is still deeply tied to the broader industrial economy, no matter how strong the AI boost is.
Precisely. They still have structural exposure to underlying cyclical risks. Despite the data center optimism, we heard management mention softness in certain global industry trends. Construction industries is dealing with softness. Resource industries is seeing capital discipline in mining. If the ISM Manufacturing Index were to dip sharply or global construction markets were to decelerate,
The success of the P&E expansion would have to work overtime to offset those other pressures.
that's it. This investment is fundamentally a high-risk bet on the flawless execution of a capacity expansion at a time when they are heavily constrained by geopolitics and still exposed to normal cyclical softness.
It requires absolute faith in that P&E future to overcome the $1.6 billion friction point today.
It's the classic case of betting on the macro secular trend AI infrastructure versus the guaranteed micro friction, the tariff cost. They're confident they can scale capacity fast enough to capture the AI demand before that cyclical friction hits margin too hard, but that window requires perfect timing.
So the ultimate takeaway for you, the listener, is weighing the certainty of that massive $1.6 billion tariff headwind and the potential for cyclical risk against the high confidence management has in the long term, secular growth of the P&E business, and their guaranteed commitment to capacity increases and shareholder returns. It's really a question of whether the scale of the long-term opportunity justifies riding out this very expensive short-term turbulence.
It's a compelling high-stakes industrial drama.
Risk defined, portfolio protected.